This is the Nedgroup Investments Podcast, a space where you can learn more about our fund managers, the funds they manage, as well as getting up-to-date and important developments affecting the investment world and how they might be relevant to you. I'm here at day 2 at the Nedgroup Investments International Summit at the London Stock Exchange, and I've managed to get some time with Andrew Parsons, who's the manager of our global real estate portfolio. Thank you for joining us, Andrew.
Thanks, Rob.
I'd like to talk a bit about the dynamics of the real estate market around the world and whether you think at this point in time we're actually in a good shape relative to history. Yeah,
look, you can never be complacent, and there's no doubt there's risks brewing. But, on the face of it, what we're seeing is basically a real estate market that's broadly in balance and not showing, evidence of excess in broad terms. Now, obviously, there's some exceptions, and clearly, we don't have to talk too long before retail pops up. But broadly, if we dare I say it, exclude retail for the moment, most areas of the commercial property market are actually in pretty good shape. I mean, you're seeing reasonably high levels of occupancy, reasonably consistent tenant demand, and fairly, I think, moderate, dare I say it, normal levels of supply. So, when you're 10 years into economic expansion, you'd expect there to be signs maybe of some brewing overbuilding and deteriorating occupancy. But, from what we can see, not huge signs of that. And pleasingly, the other side of the equation is how it's financed. We're not seeing excessive levels of interest being shown by debt providers, or at least by the real estate REITs in particular in taking up debt. So when we look at the overall picture, we see a fairly, benign set of circumstances. But as I said at the outset, one big caveat is that there is one part of the real estate market that is doing it particularly tough at the moment, and that's retail property. And so that's probably the biggest challenge at this point. But yeah, if, it all, like everything, let's keep a close eye on the economy.
So you touched on it there, strong balance sheets, and that's mainly driven by good management of those REITs. Why is that? We had a good question earlier today. Why do you think management has been much more careful with capital allocation?
Yeah, obviously the REITs were at the forefront of misadventure in 2006 in terms of over-leveraging. And I think they've taken their medicine, and the lessons learned have been painful and have endured. So the REIT industry has been far more responsible in the use of leverage, and hasn't been, generally, I highlight there are exceptions, but in broad terms, we haven't seen, mismanagement of balance sheets to the same degree that we saw, 10 to 15 years ago. And a lot of it is experience, experience has been a costly but valuable lesson.
And we've seen the attraction of the REIT market come through in the returns from 2019. So it's good returns for last year. Thank you very much for that. But where to from here? Are there any pockets of valuation, or what's the most attractive areas of the market?
Yeah, look, I think everybody's sort of been highlighting fairly elevated valuations now for probably the last 3, 4, 5 years, and clearly QE has had quite a profound impact on the economy and asset values in broad terms. And real estate is not, divorced from that reality. We've benefited from very favourable conditions in the form of low inflation, moderate economic growth, being somewhat inflated further by this QE phenomena. So trying to find value, it's as much a relative value issue as an absolute value, as dare I say it. But some of it depends on what your outlook is for inflation and interest rates. And we're yet to see clear evidence of inflation pressure or cost pressure leading to a breakout of inflation. And until we do so, and if we continue to see this moderate economic growth picture, then these conditions should point to continuation of competitive returns. So in terms of pockets of relative value within the space, that's the critical issue here. And, to some degree, you're seeing broadly, some office markets where we think that, again, replacement costs are rising and supply somewhat limited, and we're seeing good tenant demand. So we continue to, really remain positive on some parts of the office market. In particular, the west coast of the US is clearly a beneficiary. The Sydney office market in Australia is experiencing, again, pretty low vacancy rates historically by historic standards. And as a consequence, again, good real rental growth. So we remain pretty constructive on areas such as that. Selectively in self-storage, it's a phenomenal cash flow in terms of you don't have huge capex, capital expenditure leakage. And so in those markets where there's supply constraints, such as the UK and Europe, you're seeing, we think, very good returns. And so we've got some exposure to some vehicles that have got outstanding platforms in these markets. We also think that, things like in the US medical office buildings, these are doctor surgeries that, basically are a little less susceptible to economic volatility, the basic needs of healthcare. Again, the rents are such that you're not seeing huge amounts of construction activity take place. So we think there's some good relative value within in pockets of the healthcare industry. So we're finding it in pockets. But yeah, clearly it's a challenging set of circumstances at the moment.
And so,
when you're trying to, create, positive returns, and you can see things are elevated, we try to keep an open mind, because this issue's now been going on for 2, 3, 4 years. People have been worried about elevated valuations, and eventually, as we know, history shows, we will be caught out. I'm talking about in broad terms. So what we're trying to do is build into the portfolio a good mix of income streams, of cash flows that we think can go through the cycle, because, we've never suggested that we're going to try and pick the cycle. All we can try and do is look for those investments that we think are better positioned to go through the invariable or inevitable changes in economic conditions, and have a good mix of them, good diversification to generate, we think the best possible returns.
You mentioned healthcare there. Are you still holding Assura here in the UK? Yeah,
we are. That's been, again, a great story for us, and shows the benefit of patience and your time frame perspective. I mean, we made an investment in that stock, at least I think it was 7 years ago. And for the first 3 or 4 years, the stock did very little. But to us, it was just a great cash flow that the market hadn't fully appreciated the qualities of the cash flow. And then about, coinciding with, I guess, Brexit, and people started to get concerned about the UK economy and looking for good cash flows. And then guess what? They wake up and they see this stock called Assura with, average 15 to 20 years left on leases, backed by rents paid effectively through by the NHS. These are great quality cash flows. And sure enough, that stock has had a fantastic period that, we didn't predict when it was going to happen. And not every stock in the portfolio is going to be on fire or whatever in a short period of time. But, these things come unexpectedly, and you've just got to make sure that you've got that mix. And when they perform, you'll get the benefit.
And looking at supply-demand dynamics, if we take the residential market with urbanisation and the continued increase in demand for space of residential units, how's the environment in terms of local regulators or local authorities in that space?
Yeah, this is one of the big challenges for society and governments, is how to house people in established cities in an affordable fashion. Clearly, population has migrated to some of the bigger urban cities around the world because of the lifestyle, because of the work opportunities, because of the infrastructure. And it has put strains on the situation. And supply, construction of new apartments, ironically, has not kept pace. And when I say ironically, remember that, 12 years ago, we had too much residential property being developed, admittedly in the wrong locations. But now we have this shortage of residential property being developed. So governments are struggling on how to manage this dynamic. They're getting a lot of backlash about rising rents and the inability to afford to buy homes for young people. And so they're responding in various ways. And sometimes it's unfortunately probably detrimental. It's a Band-Aid solution that's actually counterproductive because, for example, they're putting rent controls, caps on rent growth if, in fact, in Berlin you've got a freeze, no rent growth at all for the next 5 years. In the US, you're seeing rent caps, so a maximum of, I think it's 5% above the rate of inflation. In Dublin, it's 4% maximum rent growth in many parts of Ireland and Dublin. And so this is a big challenge for governments because whilst that might seem to be a short-term vote winner to, control rents, the reality is what it'll do is dissuades supply, dissuades development. Because developers know that they're not going to be able to get a great economic return from investing in residential property. So the challenge is supply, and what governments are doing is actually, as I say, it's counterproductive. They're actually dissuading the solution. Now, I understand why it's not an easy solution. Nobody wants to see more and more supply hit the market because, of course, it is disruptive to where you live to have all this new construction added, and so it's a difficult environment. It's a difficult, challenging environment. But there is only one solution. If you don't bring on supply, you've got to basically limit population growth, and if you don't, then the city will deteriorate over time. It'll take a while, but it will happen. It'll deteriorate. You don't see new supply built. Therefore, older stock doesn't have to be competitive with new competition, new supply. So existing landlords then underinvest because they know that tenants are stuck in place. There's nothing new to go to. And so the city gradually deteriorates. And I think that's any good for anybody, quite frankly. So, it's a long-winded answer because we all agree it's a very complicated, challenging dynamic. How do you cause the least amount of disruption and maintain the beauty of living in some of these cities without too much construction, and you've got to put in place the infrastructure, the transport, the schools, the hospitals. It's a big, big challenge, but unfortunately, it doesn't seem it's being dealt with in such a great fashion by many cities around the world.
Okay, well, thank you very much for that. Nedgroup Collective Investments is an authorised collective investment scheme manager in terms of the Collective Investment Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za.